Leading the Dow today was Apple. Another vote of confidence from Warren Buffett. Caterpillar lagging the index. Over in the S&P, H&R Block was the winner. Dollar Tree was the biggest loser, Mike. The context matters, but you did have a number of factors starting overseas that sort of rattled investors here today.
Yeah, that's why I think we started out in the defensive. You had the dollar that got firmed up, some sloppiness in emerging markets, both in the stock markets and in the currencies. And, you know, this stuff all comes around when it was time, I think, for traders to pay attention because the market got a little bit overbought. We were stretched to a new high. The pullback was, you know, pretty mild. I don't think it really changes much of the story. The S&P 500 kind of finishes just above 2,900. So we'll have to see if it develops to anything else. I think the muscle memory right now of not panicking when you get a new tariff headline, it's very well in place, and we'll see if that gets redeemed again.
Mike, of course, the question when we see big moves, whether it's in the Argentinian peso, the Turkish lira recently, is always one of contagion. Yeah. But are we also getting a sign that if an emerging market has borrowed a lot in dollars, there's kind of nothing they can do to stem the pressure when the dollar is rising? And so could we see all sorts of other emerging markets join the party, where therefore it doesn't matter about contagion, it just matters about the effect on global growth?
Yeah, that is the question. And honestly, that's why I think the fixation on the value of the dollar itself, because that's both kind of cause and effect of all this. You know, you're going to see the sort of capital flight. It's going to manifest that way. And that's the transmission to our markets, really. It's not so much about, you know, the creditors that are on the hook for the emerging markets debt. It's much more about how it upends the general risk-taking profile of the capital market. So, you know, we went through this with Turkey not that long ago for a little while, still going on, of course, over there. And I do think it's a wait and see right now. But we have buffers in this country. It's just a question of how strong they are.
And Victoria gets to this theme and this sort of question we've been asking. Good, strong growth in the United States, slowing global economic growth. And when you see meltdowns in currencies continue like we saw today, is that a concern for U.S. growth?
I don't think it's a concern for U.S. growth. When you look at Turkey, when you look at Argentina, a lot of that is really specific to those countries. Really, they're only second to Chile in the amount of dollar-denominated debt they have. It's around 20% of their GDP. So there's issues that go on specifically with them, their current account imbalances, their inflations. I don't really see it as a contagion effect that will flow through the U.S. However, it does just add a little bit of risk to the market. The market doesn't like any kind of uncertainty. So if we start to see that expand, then I think you can see the markets get a little bit nervous, but I don't think we'll have a large reaction to it.
Mike, it's true that in the last 3 weeks, the correlation between the dollar and equity markets has been strong, or the negative correlation.
Yeah, absolutely.
And I mean, will that continue for the rest of the year, or is this something that, as long as it's Turkey or Argentina that's driving the dollar higher, that can be shrugged off?
I don't know if it can be entirely shrugged off. I mean, you know, the dollar index is within a range, right? It's not as if it's making new highs, and even when it came off, it really was not going back that far in time in terms of levels. So I feel as if it's been a near-term catalyst. It's been a trading cue in the absence of earnings and other things. So a lot of stuff gets boiled into what the dollar's doing, right? It's Fed expectations as well, just as, you know, general capital flow.
It's also not necessarily a good historical indicator for when the dollar goes down, stocks goes up. It makes sense, I guess, with exports and with corporate profits overseas, but if the dollar's going up for the right reason, which is better U.S. economic growth,
which we saw for months this year, and many times. That's why I say it's a trading cue right now. It seems like we're in a phase where it matters more than usual.
Kevin, what's your view on this sort of emerging market turmoil we're seeing at the moment? Is it something that makes you want to pull money off the table from U.S. equities or not?
Actually, you hit it right on the nail. I spent most of the day today going back, looking at valuations of Asian companies, which are starting to get really interesting. Their equities have declined in many cases over 20%. And then when you take currency into account, you've almost got a 33% decline. And yet these are companies in some cases that are growing in high double digits. It looks, to me, attractive to start taking some off the table. In my case, I've got about 19% invested internationally, the majority of that in Europe. My Asian exposure is nil. It's practically only 4%. But now, when I look at it, I'm saying to myself, why not take 15% off the table domestically? I'm like everybody else, made 10% in the S&P, and get many of these Asian situations. I'm going to use indexes. It's easier to do that. There's so many of them available. You can use ETFs or just buy the indices. But the Asian indice looks really attractive. The multiples are practically 20% cheaper across any sector you look at. Now, I may not catch the bottom, but over the next few weeks, I'm going to raise my Asian position up to about 8%. as just
Kevin,
a play for the back end of the year.
If you're buying the MSCI Asia, you're largely buying the China index. So are you content that the worst of the Shanghai market decline is behind it? I mean, there's a lot of pressure on China, whether it's trade or debt levels or currency weakness.
No, I don't use a broad indice like that. I use something a little more fine-tuned from FTSE Russell and OASI, for example, which is very specific, includes Asian engineering companies, Australian companies that service Asia, that kind of thing. But you're right, I'm not going to catch the bottom. But I don't have any exposure. And in addition to that, I'm overweighted North America now because of the success of what we've had, not only in vis-a-vis currency. Look at the USD at the high end of the range. And secondly, the other currencies, India, for example, has been crushed. And at some point, and I realize nobody rings the bell at the bottom, everybody says that. But at some point, putting on a position and averaging into it over the back end of the year looks attractive to me. I just look at valuation. I'm always screening for valuation. It's getting interesting.